You know, it's funny because everybody's talking about recession, right? Like all of a sudden, right? We have the inverted yield curve. We'll get to that in a second. But here we are in a recession, yet we're seeing the markets continue to move higher over the past few weeks, right? So everyone's worried. And now we have the inverted yield curve, which automatically means, and you know, just to put this in perspective, guys, I know you're hearing this a lot. We want to explain it, okay? So the 2-year and the 10-year, right? So it's meaning that the yield on the 2-year treasuries is higher than 10-year. Whenever that happens, that's an inversion, and that almost precedes every recession. That's true. However, it's happened a lot where we haven't had a recession, right? So, you know, how should we look at this, right? So, you know, it's, if you're looking at over the past 40 years or so and how many recessions, I think it's predicted 6 of the last 7. And for me, when you're looking and you're listening on TV, everyone's talking about the 2-year and a 10-year. I like to focus the difference between a 5-year and a 10-year. Dan, I don't know about you, but that's much bigger because it doesn't have that inversion all the time, and that just inverted as well. And the last time that happened was 2006. I don't have to tell you what happened in 2007, right? Which is the credit crisis. That's when it began, 2008. So, you know, I could see the nervousness, but I want to get your thoughts on it because now it's inverted. That's the top story. Recession's coming, and the media loves that word recession because it scares the shit out of everyone, right? It does.
Right.
And a recession is defined by 2 straight quarters of negative GDP growth. So if you have negative 0.01% growth, or, you know, which is not growth, and then you have 0% growth, it's not a recession. But I assure you, the whole entire world is going to feel like they're in a recession, right? So, you know, what are your thoughts about the inverted yield curve? Should people be paying attention? Is it a lot of noise? I mean, what are your thoughts?
I definitely think people ought to pay attention to this just because it doesn't necessarily mean we're having fun with this countdown and things like that all the financial markets will run. But everybody should pay attention to it because it is important when investors are thinking that interest rates are going to be lower in the future than they are right now. That's because they see problems down the road. That's a simple way to think about that. What caught my attention, Frank, is Mr. Market. You take all the analysis of everybody. They are now pricing in, according to Bloomberg and such, 7 to 9 interest rate hikes, depending on if it's 0.25, 0.5, whatever.
I feel we were just talking about it not long ago when we were talking about 3.
Right. Yeah, exactly. And it remains to be seen. I mean, it seems like they're going to be aggressive and all that, but forget that for a moment. More importantly, as this article points out through Reuters, I believe, they are pricing in 3 rate cuts in 2023 and 24. Mm-hmm. Take this with a grain of salt. I think this is an opportunity for individuals, for us little guys, because don't fear a recession. Yeah, maybe prices pull back 10% and go sideways. This is the whole hard versus soft landing type idea. As interest rates rise, is demand and the economy going to come grinding to a halt and lead to a market crash to get inflation under control along with rising interest rates? Or can we just manage this? Hey, it feels really bad, but markets are only down a little bit and they're bouncing around. That remains to be seen. But pullbacks in certain areas that we've been talking about for a long time around this news of recession fears like energy and such should be used as buying opportunities, in my opinion, and you want to get boring down the line. So you want to look at fuel, transportation, chemicals, and situations like that, in my opinion, for that slower from high growth to more economically or well-run businesses on the economy side.
No, I hear you. And you know, we've talked about ways to play this. But the fact that the inverted yield curve, and just put in perspective, when you look at, and you know, every company does this, but you know, CNBC said they have their top 10 tickers, right? The search of those tickers. This way, you know, you're finding out what people want to know and everything. Of course, the meme stocks are in there, oil is in there as well, and you have Apple in there. What was in there for the first time, I think, ever was the ticker for the spread and between the 2-year and the 10-year. So that tells you the average investor is really concerned about that, right?
Yep.
Which is something that's weird. And I can tell you, from that perspective, I wouldn't be concerned. Like I said, it's a different world. The Fed's sitting on $5.8 trillion in treasuries now that it bought since COVID. That changes the thesis of this when it comes to inverted yield curve and how it leads to recession. It does signal that something's off, right? When treasury buyers are willing to go out longer in their maturities without demanding more money. So I understand that point, but I want to say that the inverted yield curve, it's just noise. Okay, for you, the retail investor, which is what we care about, the podcast is about, and I think that's why a lot of you listen to it, because you're sick of hearing the bullshit every place else, is use your common sense. Just like you did when you saw inflation running wild because every bill that you paid was much, much higher. Okay, you saw it running wild while the Fed, the so-called smartest people, supposed to be the smartest, that's what we hired them for, the smartest people when it comes to the economy, had absolutely no clue this was happening. And still has no clue since they only raised rates by 25 basis points 2 weeks ago, right? That's why we're so out of whack and we have inverted yield curves anyway, because we should be 2 to 3% on that Fed funds rate. Not okay, well, we're going to slow down. Remember everyone's saying, well, the Fed's not going to do that. They're not going to, they don't have a choice. They don't have a choice. Again, this is what's going to happen if you slow it. If you do, you're going to have inverted yield curves. You're going to have things all over the place, shit going crazy, meme stocks going up 300% one week and down 75% the next week. This is what's going to happen if you decide to do this because there's so much confusion. There's so much money. There's so much trading algorithms right now, and nobody knows what the Fed's going to do. But the market is telling the Fed that the Fed funds rate should be at 2-3. That's why you see mortgage rates through the roof. Now, for you, using your common sense, you seeing the cost of everything you pay up even further, more dramatically than ever. It's not slowing. Oil, gas, food, electricity, cars, homes, you name it. Every single thing you buy is higher in price. Now you try going to buy maybe a bed, golf clubs, a car, and you can't get them since there's supply chain disruptions, which means if you're looking to buy any of those things and tons of things, it's going to take more than 6 months. No one's getting stuff delivered in less than 6 months. In the meantime, prices continue to rise. Now you notice in that vacation you were planning. Oh, we can plan it like 2-3 months ago, cost $6,000. It's $9,000 now with hotel prices and fees and everything else. Maybe you think about purchasing real estate as an investment, and you're willing to pay $1,600 a month for a mortgage at 3% in October. Mortgage rates are 5% now. It's going to cost you for that same loan, which is at $400,000, which is the average loan in America for a mortgage. It's going to cost you $500 more, $2,100. You just looked at your monthly statement. It's down over 10%, and much more if you own aggressive names in tech, biotech, meme stocks. On top of that, your accountant just told you how much you owe in taxes because you kicked ass last year in 2021 when the market was much better. So now you're noticing a shift where you're being forced to rein in your spending. Everybody across the board. I mean, who's going wild and spending like crazy? They're seeing the conditions. Everything's higher, right? So yeah, everything costs so much. Gas price over $4. These are a sign that we're already in a recession. If you need an inverted yield curve to tell you that, or we're going to see that right now at this time we're in a recession. Okay, the Fed is removing the punch bowl, and I know earnings are good and GDP growth is strong. However you want to define as recession, define a recession. But you are going to see companies, especially this earnings season coming up, the guidance. That's what earnings season is about. You can report shitty earnings and say our guidance just, you're earning $1, you expect to earn $1 for the rest of the year, and you say we're going to earn $3, your stock's going to take off. They always worry about the future. CEOs are crazy to guide aggressive right now, especially in the auto industry. If they are guiding aggressive and stocks are going to go up, it's going to be used as a massive short opportunity, at least for the smart money. Because that's, if you're looking at growth, is going to come down incredibly. And we're seeing that. And if you're not seeing it at Apple, you're not seeing it in Google, you're not really seeing it in Amazon. Those are not growth stocks. They're tech stocks. There's a big difference between technology stocks and growth stocks. It's two different things. These are companies are generating tens, if not hundreds of billions of dollars, right? In earnings, revenues. I mean, the cash flow is tens of billions, right? These are different companies than the snowflakes that aren't generating that type of cash flow. So whether we are in a recession right now or we're going to a recession, you need to prepare because stocks are going to come down tremendously before. Usually when we find out there's a recession, we find out 2 years later, oh yeah, we were in a recession then because, GDP went negative 2 straight quarters. It doesn't matter. We didn't know it was a recession until the end of 2008, that really 2007, the recession started. It doesn't matter. What matters is you're seeing people spend less. There's less money going to the economy. The punch bowl is gone. And you have the Fed tightening for the first time in history. They're tightening while we have horrible, horrible market conditions. Usually you're tightening when things are much, much better. But again, they need to control inflation because they just went off the rails. So long-winded here, prepare for a recession. We're basically in one right now for the majority of people. And you don't need an inverted yield curve to tell you that. Because yes, it has predicted recessions, but it also gave us false readings many, many, many times. So for me, I'm not looking at an inverted yield curve. I think it's funny that we need that to tell us and everybody to worry about the word recession. You got to prepare for recession now. And that's what we've been talking about, right? I mean, different sectors and stocks that you should be buying to prepare. Because a recession, not everything's going to go down. There's going to be things that are going to do great, like banks and crypto and stuff.
Right. And I don't want to make excuses right now for the future, but we've talked about different reports and things like that about people talking about, hey, manage your expectations on future returns. The last few years have just been absolutely gangbusters, even above the 8 to 10%, whatever you want to pick on historical averages. the idea of earning or losing less comes into play with that as you go and steer this economy. Two things to take in stride right there. Earnings season is going to be really interesting coming up on guidance and things. But remember, the Fed, and this will be an easy transition to Willy Wonka and the craziness of Wizard of Oz here in our markets, Frank. Take everything in stride with the bond market because it's so manipulated and ridiculous with the Fed printing and buying bonds and all that kind of stuff. So they've really ruined any actual tell that i.e. individual investors are trying to tell them. They've muted that out for the most point because they control that, which is ridiculous. And two, all their finaglery and lever pulling, Frank, leads to crazy, crazy situations because so much money is in the system sloshing around, like AMC buying into the gold miner we already talked about. But another fun thing, because asset prices rise dramatically and then you have a great, wonderful game-playing CEO that gets stocks up, now a certain somebody could even buy Twitter, Frank. This is the kind of fun stuff we can have. When you have goofy money policies and so much money around, everything is on the table. And that's kind of exciting from an investor standpoint is you got to learn to laugh at stuff like this. Otherwise, you'll pull your hair out.